In this video, I'm going to be going through how you can potentially save the returns on your investments in US-based indexes such as the S&P 500 from being crushed by currency fluctuations and FX losses. And that is by using simple financial products such as currency hedged ETFs. If you, like me, are based in Europe or the UK, or any other place that is not the US, then you are going to have to manage the currency fluctuations between the US dollar and your own local currency. Because let's be honest, most of the indexes that we actually invest in from time to time are all US based, such as your S&P 500, your Nasdaq, your Dow Jones, and your Russell 2000. Back in October 2021, $1 US would get you 0.86 cent of a euro. And now a year later, that same dollar will get you €1.02, as the dollar has appreciated 20% over the last year. And it is not just the euro that the dollar has been appreciating against, but also the pound sterling. It is up around 21 or 22% against the pound in the last 12 months. This is a pretty huge movement in the exchange rate in a short space of time, and it actually has benefited a lot of investors over the last 12 months. So for example, if we take the S&P 500 over the same time period, the last 12 months, it is down 16.6%. But even though the S&P 500 is down 16.6%, investors whose local currencies are GBP and Euro would have benefited from holding their money in US dollar over that time period. If we have a look at Vanguard's VUSA fund, which actually tracks the S&P 500, it is up 4.41% over the last year. This fund is not currency hedged at all, but its trading currency is GBP, so that means it also prices in the FX movements as well as the underlying movement of the S&P 500. So overall, European and UK investors have been much better off because they have their money in the US dollar. Even though the S&P 500 is going down, they managed to still get a profit of about 4.5% over the last year. The main question that we need to get to is, when is the actual right time to use a currency hedged ETF? When you currency hedge any ETF, and let's take one that tracks the S&P 500 in this example, you are protecting yourself against the dollar depreciating in value against your local currency. Essentially, you are just completely covering yourself off to any negative movements in the exchange rate. But it is important to note that when you actually hedge and protect your downside, you do forego any potential upside. So any favourable movements in the exchange rates, you won't see any profits from that. If I held a euro currency hedged ETF of the S&P 500 over the last 12 months, I would actually be down about 16% rather than up around 4%. That is because the currency hedge is protecting myself against the dollar depreciating, but over the last 12 months it has appreciated significantly. Therefore, it is a simple enough formula that you can use to decide whether it is a right time or not to invest in a currency hedged ETF. If you expect the dollar to continue to appreciate against your home local currency, then you are better off to remain with a completely unhedged ETF. But on the other hand, if you expect the dollar to depreciate over the next while, then you are far better off going with a currency hedged ETF. The difficulty in this, as always, is it is very hard to predict the future, and it is also very hard to time the market. In my own personal opinion, over the next short to medium term, we could possibly see the dollar depreciate a bit against the euro and the sterling. And that's not financial advice whatsoever, but that's why I'm probably going to go with a currency hedged ETF myself over the next short term. But anything can happen, as we know. There's a lot going on at the moment, as we know, such as war, economic instability and energy crisis and everything. So the short term is pretty unpredictable at the moment, but maybe over the medium term at least, you would expect the euro and the pound to gain some of their strength back against the dollar at some point, but that's anybody's guess. Lastly, I just want to go over how you can actually invest in a currency hedged ETF. One really good resource that I often use that I'll show you in a second is just ETF.com. They have a really good ETF screener which you can use to filter for any type of ETF that you're looking for. If you are looking for a euro hedged ETF that tracks the S&P 500, then a good one to go with is the ticker symbol IUSE, which is a fund run by BlackRock or iShares. The expense ratio on this one is a little bit higher than you would expect on a kind of a passive fund because they have to build in the bit of FX management on it. So it's at 0.2%, and you will be able to trade that on brokerages such as the Gyro and Trading 212. I'll leave affiliate links below in the description section if you want to sign up for any of those. So I usually go to just ETF.com to search for any index that I'm interested in. I just pop the name of the index into the search bar, and then on the left hand side here I can filter for currency hedged ETFs, for example, in this instance. As you can see here from the list, there's only kind of one option that's coming up here for euro hedged ETFs, but there's a ton of options if your local currency is GBP. So anyway, that's pretty much it for my video today. I hope you found it useful and enjoyable. If you did, please make sure and subscribe to my channel and drop a like on the video if you're feeling generous. I'll see you guys again in the next one.